If you own a rental property or thinking about buying one, you should definitely watch this video. I'm going to explain how depreciation works and how it can seriously change how you think about taxes. So let's get into what it actually is. Basically, the IRS lets you pretend your property is wearing out over time, even though it's actually going up in value. So basically, it is a paper loss when in reality you could be making money. It's a super powerful tax strategy because even though you could be actually making money, you could be showing a loss to the IRS. So let's take residential real estate, for example, because this is what most people think of when they think of rental properties. So for residential real estate, the IRS lets you depreciate the useful life over 27 and a half years. Each year, you can take 1 divided by 27.5 of the building's value. And the reason that we specify building's value is that you have to account for the land's value and you can't depreciate land. So this is going to make more sense once we go into an actual example. So let's take a single family rental property. Let's say we bought it for 300,000, but the land is worth 60,000. That means the actual depreciable base is $240,000. And if we divide that by 27 and a half, we can take $8,727 in expense per year. Let's say we make $15,000 from rental income minus depreciation of $8,727, and our taxable income is now $6,273. And so that drop is a huge difference. This is just one property. So imagine once you start stacking them, once you have 2, 3, or even 10 properties, how powerful it could be. The reason why this matters is that it essentially shelters rental income from taxes. And once we combine other expenses, mortgage interest, utilities, and things of that nature, we can actually be in the negative and showing a paper loss, even though you're still putting real cash in your pocket every single month. But some considerations to take into account are it can only offset passive income, so you can't deduct that from your W-2 income unless you are a real estate professional or you materially participate. But that's a whole different video. Another thing to take into account is depreciation recapture, which means when you sell the property, the IRS is going to want some of that benefit back. But even then, there's strategies like 1031 exchanges to defer or reduce that. Don't let recapture scare you away. Just plan for it accordingly. So that is depreciation in a nutshell. It's basically a deduction with no money spent. It's powerful for getting out of the rat race. As always, talk to your tax pro. Do not try to do this one by yourself. And if you have any questions, please DM me to talk about your situation specifically. Thank you.